This week in episode 8 of Around the Coin podcast, Brian Roemmele, Mike Townsend, and Faisal Kahn explain why Simple was acquired for $120 million by a 150-year-old Spanish bank. Then, Faisal tells us why the mortgage system is broken across India and Southeast Asia and explains in detail for entrepreneurs how to fix it. Around the Coin podcast.
All right, guys, how are you doing today?
Doing good. How about yourself?
Great.
I'm doing wonderful.
So today we have the recent Simple acquisition, which is a pretty big deal, causing some ripple effect. What do you guys think? Do you have any high-level thoughts on Simple?
Well, I can
Brian, maybe
jump in and
give us some.
I think what we define as banking is going to radically change even more than it has over the last 15 years. If you to talk to anybody who was 25 years old 10 years ago and tell them that you probably never walk into a bank again, they would think you're insane, right? Today, that's not only possible, that's very likely. The physical manifestation of a bank is really becoming less and less useful. What really precipitated that? Well, the ATM machine precipitated that. Electronic deposits precipitated that. In the United States, I don't have the exact figure, but I think it's 87% of paychecks that could be electronic are electronic. Okay, so that's pretty high number. And all government payments, all electronic benefits transfers are electronic. These two convergences have created a condition and an expectation on the part of consumers, if you will, to be electronic in payment. So we're not physically handling our money anymore. We're not touching, in America, dollars and coins. It's all electronic. So it starts with this idea. I think the real revolution was when people were getting paid electronically, and then winding up dispersing those funds through, ATM debit cards and checks, and a certain sector of the population who may quote unquote be unbanked are getting a payment card, a vehicle to use to pay for goods and services, and potentially online bill payment. So that's the direction where it's going in the United States. And Simple is sort of on the leading edge of that. And what's interesting is the way a lot of people look at this is it's always about the unbanked or the, non-served individuals. And it really isn't about that. It's about the shift of how people have changed their relationship with money. And we're in the middle of it. I could go on for quite a while on how I see this shift is going to constantly change.
We had a few years ago in 2009, I believe it was, Mint.com was acquired for about $170 million. This is Simple being acquired for 120, 117.
Yes.
A lot of people compare the two companies. Mint is really a consumer tool. They integrate with your banks, but Simple largely does the same thing. Simple is not a bank. They're just the intermediary between the FDIC insured institutions. Do you think that there's a lot more opportunity?
Yeah, but that's sort of like saying that the iPhone isn't really a phone because it's using AT&T or Verizon or anything. The reality is the function under this model, I'm not saying banks are going to become completely irrelevant. I think there are things that banks are doing and are going to do that is going to continue to create relevancy, and that's sort of a different topic.
For all intents and purposes, to the user, it would be a bank, right?
There's no doubt about it. This is the consumer-facing side, and it is a dismediation, if you will, and it's a beautiful concept. And the fact is, we could talk about, it was 1969. It's not that long ago when the very first ATM was dropped at Rockefeller Center. a bank called Chemical Bank, which is now Chase Bank. And when they dropped that technology out there, they didn't drop it to save money. They dropped it as a way to make money. They said, well, we're going to put this ATM out there. It cost us a lot of money. So we're going to charge, I think it was $3.20 anytime you went to the ATM machine. And it's just interesting how these things have progressed. Now, obviously, ATMs and banking out in the street level have changed the experience tremendously. In some ways, it's almost to the point where you have people, saying, well, why do I even have to go into the lobby? Just, put that ATM machine on the side of your building and that's it. And obviously that's where it stands today. So really, to a lot of people, and I think the percentage is 73% that use banking today and access an ATM, never walk in a front door. They're just going to the side of the building. That creates opportunity. A lot of opportunity.
If they do, it's they don't want to. It's a friction point. They do if they have to. They validate their identification, but they don't want to do that. They want to use the iPhone that has your fingerprint scanner and not have to leave the comfort of their house. What's interesting, I thought, about Simple's acquisition is that they were acquired by the 34th largest bank in terms of total assets. Are there going to be 33 more? Are there going to be consolidation? Because what they're doing is allowing Simple to run as a completely separate entity, almost like Zappos and Amazon. Zappos stays the same. Simple will stay the same. What's going to happen to Simple? Are they just going to keep acquiring users and maintaining that growth, or are other banks going to start looking at buying or acquiring or building their own more, you could say, better user experiences?
Well, I think a lot of banks would advocate the fact that they're already innovating and they're already doing these things. But the problem is they're creating an environment where people feel like they're being siloed and funneled into a specific bank entity. And the independence, the apparent independence of these, I feel like they're meta banks, is actually something that's attractive. It's one of the reasons why, Walmart is quickly becoming the largest bank in the United States. When you look at the functionality of their payment cards. So it's a consumer experience, and banks have been laggard in understanding how quickly to take advantage of the shifts in technologies. It's changing, and a lot of different changes took place.
I want to give a perspective.
It used to be a tool.
I want to give a perspective. For me, changes in the banks that's happening of late are analogous to what email did to the fax or what the mobile phone did to the landline. They absolutely disrupted the whole thing. And Simple, like the mobile wallet, is doing the same thing to the traditional bank account. And I think Simple is an example of that. It's a middle layer that if you could afford to underwrite yourself, and if you're sick and tired of the existing onboarding and interactive process with the traditional banks, you have a market as a middle layer, oblivious to what bank is at the back end, and you're servicing customers that you feel need to be serviced in this day and age. And that's what that's Simple's simple formula, no pun intended. And I think regarding the Spanish bank, I don't know if you know, but Spain has historically been one of those countries that has actually experimented with very new types of ATMs and payment systems. This is one of the reasons why the Mobile World Congress happens in Barcelona, in Spain, and not anywhere else in the world.
Good point. Absolutely.
And they're very, very they're open to experimentation. So, and I think Simple is an experiment that other banks are sort of waiting in the sidelines, seeing how it folds out. And the bank in Spain said, hey, I'm not going to wait. I'm going to grasp this and go for it. And that's exactly what they've done.
Why Spain? Is there just a few guys over there, the executives of those banks, that are a little more progressive, or do they have some better system?
I think it's Spain has got a few things working for it. The mobile, the conference that happens over there, the World Mobile Conference, that's one thing. The second thing is their unemployment rate is quite high. So they're looking at innovative ways in which they can make more tractions. Their ATM design, they're one of the first countries to go to a very unique and maverick ATM design that's rolled out over there in quite a few places. there's so many geopolitical factors that are common to Spain that have somehow made them at the forefront. It's not very easy to pinpoint them, but they've been they're very forthcoming. They look at it as an art form, and they're experimenting with this art form, and they are willing to invest in it. And $117 million peanuts. If you can revolutionize the entire banking industry in Europe with that kind of money and interface or a middle tier, why not? I mean, that's a fantastic buy.
Faisal brings up something very interesting. It was at the 2011 Mobile World Conference that chairman of BBVA, Francesco Gonzalez, created a handwritten note and sent it to, I think, Shamir Karkal, one of the co-founders of Simple. And Shamir was really being quite negative about how banks were approaching technology and specifically customer service. And, that really intrigued him. And it was that particular moment where this all took place. It was literally at a conference. Now, the Simple was only 13,000 customers at that time, maybe 11,000 customers. Today, they're still only 100,000 customers. They're relatively small, but they have a powerful impact as the future. I mean, everybody I know that's in this space always sort of bring them up and saying, well, they pivoted, they were going to be a bank. And I never saw that. I saw them always as being in the frontmost layer.
I think Simple is more or less like Brett King would say, the bank 3.0.
Sure.
Mm-hmm.
So they're the bank 3.0 version. They are, they added a middle layer between the customer and the traditional bank, and made it work for what people are wanting right now in a banking system, how they interface, how they interact. I mean, it's the same bank at the back end, but it's just it's the front end customer onboarding experience that is 3.0. I mean, we still have web servers and they still serve HTML, but there's a huge difference between web 1.0 and 3.0. And that's the way I look at Simple, bank 3.0.
And those things make all the difference in the world. For instance, I use USAA, and as a bank, they're great because they have no physical locations. And you're comparing that to, I'm looking at a list, Wells Fargo has 6,300, JP Morgan 5,700. USAA has essentially zero. And they're smart about it because they don't fail on the experiences that you need. For instance, if you need to deposit a large check, anything over $5,000, they have a machine that they've built and released in every UPS store. So there's UPS stores that you can walk in with a USAA check. They scan the thing, they look at your license, and you're all set to go. And it's in your account the same day. Because essentially, what does a bank do? A bank essentially was created to validate your identification. It was used as a selling tool. You come into the bank, you create an account, you talk to the sales guy. You don't really need that anymore. I think, to your point, Faisal, Brett made an interesting point in his speak when he said, you can touch a customer 20, 30 times in a week if you use their mobile app, but maybe once every 6 months if you have a physical location. And then look at the overhead involved. So, I mean, if you look down, there's tens of thousands of banks. It wouldn't surprise me if, in the next 5-10 years.
It's like the Spanish bank had access to HTML5 and no one has it. And they went and they got it.
That's beautiful.
Simple as that. And I think, and just one more point, and I think, and I quote Brett King again on this thing, he says, it's not a risk. Other banks, traditional banks, are looking at it as a risk, to go this route. And the way he sees it, he says it's actually, it'll be a risk if you don't do anything about it. If you don't change yourself, that's a risk itself. Not sitting on the sidelines. That's not a risk. Sure. The risk is not changing it. And remember, we have people who are born and raised as Gen Y who are now coming into the banking sector as customers.
Well, if you look at banking and you look at the thing that is most invisible to everybody about what banks really are, the real thing that banks offer is trust. They're creating an environment where, let's face it, I mean, you give somebody your hard-earned cash and it's electronically being deposited. You want layers of trust. You want to know that that money is going to be there. And look what happens the moment that insurance isn't there at a bank. FDIC in the United States and other parts of the world, there was a country that decided to deduct a certain amount of anybody who has over $100,000 in their bank account just because. So, that creates a whole lot of distrust. Now, what really is a bank anymore? I mean, can other institutions build all of these other sort of infrastructure relationships? Well, yes, they could. Now, legally, there are some, things that stop that. And so why are people fearing becoming the bank? And we talked about this in prior shows. The fear is it slows down on innovation. There's things that you can't do within the format of a bank holding company. And there are things that you wouldn't want to experiment with in the United States. But outside the United States, companies like BBVA have had some incredible fast tracks in testing things out. Australia is another case. I mean, Australia is a great test bed for technology. It's a great place for every startup that is doing anything in payments to be the next country. I've advised that for a decade now. But when we go back to the banking relationship of not just somebody who's, below the age of 16 moving forward, but all of us, it's already transformed. I mean, people are looking at the bank at milestones in their life, right? What are the milestones? Well, if you're a wage earner or something like that, one of your milestones might be getting a car, a college or university loan. If your parents didn't do something, maybe the bank would be a part of that. And then finally, the mortgage is the huge milestone within the life of most people. Now, those milestones traditionally were banking functions. In fact, the early savings and loan and the Wonderful Life story, if you go and look at It's a Wonderful Life, I tell anybody who ever wants to start in payments, go and watch that movie through the eyes of 2014 and look at what this guy was trying to do and look at all of the different complexities of what was going on. Who was controlling the financing? And why was it so hard to have a savings and loan? And why was there a run on that savings and loan? And how would that change today? Because the savings and loan really wasn't a bank. It was kind of like a startup. It was somebody, it would be like kind of simple as today in some regards. It's a place to sort of interact with your money and hopefully at some future date, take that money and use it to buy your own first home. And so you look at this functionality. What did a savings and loan do to somebody in the 1940s? Well, you couldn't go and get a mortgage in the 1940s easily. The only way you could do that if you're a working individual was to go to a savings and loan, and you would take the money of everybody else who's a working individual and use that to get your home. And, that era is obviously gone. And we're in a completely different world now after what happened in 2008 with the mortgage derivative meltdown. But those foundational milestones in banking, those are opportunities. These are places where I think the future is going. How do people interact with their relationship with money? What does credit really mean? What does a debit really mean? These things are all going to redefine. And we're already kind of doing that. If we're receiving our income electronically and we're paying our bills electronically and we're not interacting with our cash in any regard, we're already in that world. We just don't really quite know it. And the interface is going to change.
There's the traditional banks, if you were to look at the problem and say, okay, we're going to wipe the slate clean. We're going to go back to the drawing board. We're going to rewrite the complete processes of onboarding a customer the 2014 way with the 2014 technology. There is so much inertia and so many people would lose their jobs. So many processes would have to be destroyed and new ones to be made that it's almost impossible for a huge bank like, let's say, Bank of America or Chase Manhattan, what have you, to implement something like this. And that is exactly what Simple saw. They saw that there is an inherent problem in the onboarding and customer services. If I can create a middle layer and service them and somehow negotiate an agreement with the bank to get better charges, the differentiator is my income, and work on that. And that's exactly what they did and took it on board. But now today, if you were to look at the traditional banks, they're very cognizant of where they lack. It's just that the cost of inertia is so high that it's not easy for them to roll such things, such things out.
Faisal, I have a question, and I really want to see this perspective. Walk me through the process of buying a home in your part of the world, how do you get a mortgage? What's that whole
Unfortunately,
like?
in the entire South Asia, Middle East, and almost all parts of Southeast Asia, mortgages is a privilege reserved to a very, very small part of the population.
Single digits, double digits,
Maybe even smaller than single digits. It is such a small thing. This is why this is why do you think people live with their parents? For the same reason, they can't go and buy it. Property prices are so high. Buying it, it's all cash. I mean, you have to have the money to buy it. There's no way you can get financing because things like 30-year mortgages or 25-year mortgages, unheard of. Heard of only for those people who've been working in the industry for a good 15, 20 years, have a senior white-collar job, stable income, et cetera, they might qualify for something like that, but not to the full amount. Absolutely never to the full amount. But mortgages in this part of the world,
How about loans? How about?
Yeah, I was just going to ask, and on top of that, not even just loans, but between the banks, is there a difference? Because in the States, there has to be a.
See, this is the predominant differentiator between the banking system in the U.S. and Europe, and the banking system in this part of the world, which is South Asia, the Middle East, and the Southeast Asia. The mortgage, the real estate element is absolutely a miss. I mean, it's just not there. If it's there, it's negligible. It doesn't show up on the map. And the income model of banks over here is more on consumer loans, not house loans, consumer loans, car loans, television, credit cards, what have you.
Walk me through a car loan. I mean, is that a bank experience? Is it how would I get a car loan in
well, same thing. You have to qualify. Your credit rating would be checked if one exists. But
do I physically walk into the bank? I mean, it's the whole mechanical process.
It's a very antiquated process. It's a very frustrating process, and it's a very invasive process. Invasive as in the sense they'll actually go over and ask for all the intimate details of your income, where you live, who do you live with. Well, okay, so this house is owned by your mom. How much does your mom make? All those stuff. Wow. Because and they have the right to take the car away if you don't do that. But it is such a one-sided equation, and it's in favor of the banks. It's not in favor of the consumer. Consumer protection rights laws are absolutely non-existent over here. I mean, the banking ombudsman is there, but so only so much you can do with that.
So who would originate the loan? Would I be at the car dealership, or would I go to the bank? No.
Car dealers are the least people involved. You go to the bank. Always the bank. You go to the bank. You say, listen, I want to buy this car. Your typical down payment, if you have excellent credit rating, probably be about 15 to 18%. If not, then you're looking at 25%, and it's a 3 or a 5-year lease on the car.
What's the interest rate looking like?
So if we have something, it's called KIBOR, which is essentially LIBOR. So LIBOR plus about 4 or 5%, 6%. So about 18 or 19%.
So what is car ownership as a percentage of the population in general? It doesn't have to be.
Those numbers are not published as per se because of the gray economy that exists, the parallel economy, the undeclared income economy. So officially, obviously, the production numbers are here. But if you look at the ownership versus, let's say, finance, it's a pretty small number. And it's not that small. It's probably in single digits or maybe in the low double digits. And that's because of the corporate financing. So everyone who's got a job gets the car finance and so forth,
This is fascinating. So do you feel like there's an opportunity for home ownership and mortgages in this region, or is home pricing too?
I mean, it goes without saying, it's a huge opportunity.
What's the barrier? What's stopping?
Laws. It's the laws.
Really?
The laws with respect to real estate investment trusts, laws with respect to mortgages, laws with respect to bankruptcy protection. I mean, for example, I'll give you an Indian law that's applicable here. So you go get a home, and you're living in it. You financed it. And obviously, you're living in a joint family system, so you financed it, and your brother or your siblings may be living with you, your parents may be living with you, and you come to a default position. You're going to default on your loan. So what you do is you go to the local court and you get a stay order, and you basically are now fighting a case in the court of law that will run for a couple of years. And until that case runs, the interest principal is guaranteed to the bank, but the interest is any profit is frozen. And until that case is not decided, guess where you get to stay? You get to stay in the house. So until these laws are not fixed, it's very difficult to enter into such a ecosystem where mortgages are the norm.
So do they have is there a fractional reserve banking system in place at all? I think
there's a fractional reserve banking system. I do not know of a country where one does not exist.
Okay.
So the income level, if you're asking how the bank's making money, treasury bonds, government treasury bonds, they're loaning to the government. The commercial banks get the money from the central bank. The central banks are buying treasury bonds and giving it to the government because invariably they're either doing T-bills, T-bonds, or treasury bonds, treasury bills for the government, and the current account deficit that needs to be financed, and that's how they do it. So the government is a bigger and a safer client vis-a-vis thousands of small car dealerships.
This is just absolutely fascinating to me because, in America, we have this view that everything is just like what we have here all around the world. Mm-hmm. And even though there's this sort of trend that everybody thinks that home ownership is, that dream is done, the people making those claims are probably single.
This is why, when they say, if you've never heard that word, the American dream, buying your own car, where does that come from? It's because immigrants never had access to the car in their native countries. They couldn't go and buy one, and yet they come to the U.S. and they can get one on a lease. So that's
interesting.
And they
get to buy a house
and the house as well, as well. So
and a business and the American dream exists. I mean,
at a cost, yes, but it does.
So let me ask you this. Maybe I'm not sure who would be best fit to answer this, but if you have traditional banking systems that are heavily regulated and essentially acting as the handcuffs to innovation and growth, it seems, and to some extent, is there any opportunity for a cryptocurrency to come in and, sort of liquidate or liberate some of the people to make loans?
Absolutely.
I mean, is there going to be a loaning system on Bitcoin or another?
So let me, from my part of the world, a cryptocurrency would probably never get the recognition of a fiat currency in, let's say, the coming 3 to 5 years. I mean, I can say that with some surety. Most of the banking laws in these part of the world do not have an adage or a passage or an element or elbow room to even define a secondary currency that is digital in nature. It just doesn't exist in their books. So they have to go and create these laws in their banking manuals or what have you to even define a currency like that. Even if a currency comes in as digital money, it would first and foremost, in my opinion, and I could be wrong on this thing, be treated as a payment protocol, as a payment network, rather than a currency per se, with intrinsic value. Most likely start with the payment protocol and then perhaps graduate as a currency. And even if it does, it will still be regulated by the central bank. There is a very slim to none chance that the private sector could somehow drive the Bitcoin or the other cryptocurrencies into a parallel loaning or banking sector, because the banks and the federal government, it's all about taxation. I mean, you have to understand that. I think Brian has already spoken to that. The government is interested in taxation if there is a system that could somehow even remotely offer a possibility of circumventing taxation. They want to regulate it. And I don't think so. Bitcoin has, look at gold. Gold is available plenty here, but you don't see people getting into the business of, loaning gold out, because it's not something that can be loaned out without prior permission from the central bank or the regulators. So I don't think so. Bitcoin is going to come in as a loaning mechanism anytime soon.
Well, let's do a thought experiment, right?
Sure.
And we'll base this. What is the typical middle income home selling for in converted to US dollars in your part of the world?
There are societies, so it depends which society. I live in a semi-affluent society, so let's say middle income is about 500,000 US, maybe more, and that's
and a home would cost about how much?
500,000 US.
Oh, so the home would be 500,000.
Yeah.
Now, if you were to look at the entirety of the population, where do you think the average home selling price would be? Obviously, I don't think it'd be a 500.
About 150, 170,000.
Okay. So imagine.
I mean,
if,
in Bombay, a flat in Mumbai, as they say, a flat
Sure.
is $1 million, $2 million US.
Oh boy, yeah, yeah.
And
So
that's a very small flat. In Hong Kong, it's even worse. I mean, it's $30,000 to $75,000 a square foot.
Sure. So let's look at this from a point of view of somebody who invented a credit protocol that lives on top of Bitcoin. You have the owner of the property who, let's say he's convinced to take the value of that property in a sale in algorithmic currency. And he can go and do with it what he will. We'll call it Bitcoin right now. And the new owner of that property is not the person moving in, but the person granting the loan. Mm-hmm. And it's not a mortgage. Mm-hmm. It's a rent-to-own environment. Mm-hmm. And the Bitcoin protocol is the mechanism that allows not only the contracts to take place from anywhere in the world, because a Bitcoin with its open ledger, this is so important to understand. The Bitcoin open ledger has the prospect of creating a contract anywhere in the world that can easily be opened if the encryption is allowed to be opened. And you can actually create algorithmic currency that allows for a message or even a huge data payload to be opened up at some point in time. But let's just look at the Bitcoin protocol. Within that, the sender and receiver can send a message, and that message could be the function of a contract. So now we have somebody who does not have to deal with the real estate laws of home ownership to grant a loan to somebody. Yet the person living in that house is,
that's
in
brilliant.
a way, this is where it's going.
Well, the consensus ledger allows you to do that in Bitcoin. The next homebound applications actually point to that, that specific vertical where contractual obligations in the ledger are recorded, and if need be, they can go and look at it, and exactly. so that dispute cannot occur. But the fact of the matter,
now, gentlemen, think about this. Though. Let's just go down to the nth degree of this thought experiment. Now we have somebody. We know there's pent-up demand. Just by your thesis in that part of the world, I would assert that this pent-up demand is everywhere on this planet, especially in the quote-unquote undeveloped areas. The more undeveloped the area is, the more profound this form of credit becomes. And we can look to Africa. Africa is going to be an amazing opportunity. South America, any developing country, and China even. What happens with this protocol is obviously it's a currency in some regard, but it's much, much more than that. And we took one sliver and we call it now a contract verification mechanism. But what are we doing? We're liberating the ability for you and I can sit here and say possibly that somebody in South Africa or Middle Africa, maybe a home might cost $3,000. And maybe that can be fractionalized amongst a whole lot of crowdsourcing. All of a sudden, you have now the ability to get this credit to an individual who otherwise would have to go through a tremendously complex and old infrastructure that's just hogtied with regulation. The rental infrastructure is a much more concise type of environment, except for rental control in areas, and that's already developed. It's more simpler.
Yeah.
It's much simpler. And getting the person out of that house in a rental environment, they have a lot to lose because they're renting to own, right?
I think there's no doubt.
If they default, they're losing everything.
I think there's no doubt that, obviously Bitcoin has a role. But look at the inherent problem. The problem remains is default. How do you cater to default? And if you foresee between a bank and I say this all the time, that the CFO is the CEO, because the bean counters,
Sure.
They understand it, and actuarial sciences come into play. They see, that they have to put their money in, and they can loan it out for a short period of time to the government or to some corporate entity, or a 30-year mortgage, which has obviously over the 30-year run some great prospects of making money for the bank.
Sure.
But they don't see that long term. It's too high risk for them for a median or average person. They would rather.
But that's why Bank 3.0 is such a radical concept, because
but you have to understand that in case of Simple, Bank 3.0 is not just Bank 3.0. You have to understand they are underwriting their risk with the original bank in some manner.
Sure.
I can guarantee you, bottom dollar that arrangement was done at somewhere down the line. Because no bank is going to come and say, well, yeah, sure, you can use our infrastructure, our APIs, our core banking, and all our facilities and products at a discount, and we won't hold you accountable. Since you're reselling those services, there is some underwriting process that has gone in.
I'd have to imagine it's very similar to, say, Stripe.com and Wells Fargo. Stripe does a lot of the front end interface, and they'll do a lot of the calculations to see if there's fraud, but the underlying processing is done by the larger acquirers. Do you think there's a parallel, Faisal, to LendUp, which does essentially the Web 3.0 version of small loans, payday advances or payday loans? Is that a big industry over there, or how is that structured with short-term unsecured loans?
That's a very mature industry when you talk about payday loan advancements and so forth, discounting of invoices or things like that. But in an emerging market, the regulator has a fiduciary duty to its shareholder, which is in this case being the government, to make sure the economy is balanced, the flow of money, the money supply is in check, inflation is in check, and so forth. But one of the things that they have an absolute tunnel view, if you will, and rightly so in some manner, is to ensure that the risk mitigation and risk exposure is minimized for banks. And Basel I and Basel II and the Basel III frameworks are doing it, and paid up capitals have gone high and so forth. But it's the risk part that they look at. They do not want banks to overextend out on commercial loans, get the population. See, when you extend too much credit, everyone's getting it. And then guess what? It becomes difficult somewhere down the line to pay. That's exactly what happened in 2008. Mm-hmm. Mortgage, finance, refinance, prices shooting up. Everyone was getting it. Pakistan went through the same thing in a couple of years back. Everyone had a credit card. Everyone had it. I mean, people were going and financing air conditioners and, refrigerators and cars and motorcycles and VCR and microwave ovens. And then what? The defaults started happening, and it then piled up.
How bad was it?
Pretty bad. I mean, to give you an example, of a country of 186, 87 million, we had at that point in time somewhere around close to 3 million credit cards. The total bank accounts at that point were about 22 million. So 3 million credit cards went down to 1 million today.
It's funny, just from my, small sample size, I lived in Singapore in 2009, and I would have friends that would travel to China, and they travel to Thailand all the time. And it was so common that people would have like 7 or 8 credit cards, but they would just roll the credit from one to the next. So they would, pay one credit card with the next, and that would buy them, say,
Mike,
month
when
or 2
was that?
months.
What year was that?
That was 2009. So
see, when you have ample of credit, you're pushing money in. Everyone's borrowed that money. The fundamentals are very important. Has the industry improved? Have pay scales improved? Has production gone up? Has products or services in the country, their average price has gone up? Has the GDP gone up? Because that's the only way you get to pay back. Why did they take the loan in the first place? Because they needed the money. They didn't have any savings to tap into. So if you're getting free money and you have no savings and no propensity to pay back, what do you think is going to happen? Defaults.
Yeah,
exactly.
We've seen that. Interesting stuff.
Well, let's segue into the fact that the very first ATM transaction based on Bitcoin took place in Boston today. This is not today. This week. This is a major thing, and it wasn't a bank. It was not a startup
it's a coffee
in
shop.
the Bay Area. I would debate that whether that was a real transaction in New Mexico. I would argue that the real first transaction took place in Boston 24 hours after that. Why? Because the system wasn't really self-operating. It was being helped along.
So what's the revenue model? First of all, let me ask you, what's the revenue model over here? Why would someone put up a Bitcoin ATM when regulations / legal coverage is sort of a question mark?
Well, that's the opportunity anywhere, right? The reason why we look at Elon Musk and people like that is that they go up against all of this with a determination. And the people who are nameless today that are doing this, either they're going to wind up in jail or they're going to be winding up in a front of Forbes magazine on the cover, and Elon would be the first to tell you at his days in PayPal, either one of those options were very likely with what they were doing. Yeah. So let's look at it from the reality. Is it dangerous in a sense that some regulator can come in and invalidate this? Absolutely. The rules can change at any time for any reason, but these things have to be done. The new territories somebody's got to take the horse out and go over the mountain and see what's over there. And, there's arguments that the Boston thing wasn't the first one. And the reason I'm saying that that's really one of the first ones is because it was a standalone system. The only thing that was connected to it was an Ethernet line, and you could actually end and begin a transaction through that machine. Some of the other machines that were being tested in the United States prior to that and just a couple of days before it, you didn't have a full cycle. There, you couldn't put cash in or a debit card and get really a useful Bitcoin at the other side of it. But that's neither here nor there. All of these entities that are doing this are entry-level individuals. They're people that you don't hear of from areas of the country that you would not normally say this is where, technology is going to flourish. And it's interesting. It's interesting the fact that the state of California wants to recognize Bitcoin and other algorithmic currencies as a legal currency, not legal tender. That would allow, if that bill becomes law, that will allow the United States to have a state that has recognized this as a unit of measure that can be utilized inside a bank. And so banks could get involved at that point. But at this point, you're not going to see banks deploying these ATMs. You're going to see entrepreneurs.
Right.
And I would argue...
RoboCoin? I'm looking at the TechCrunch article on RoboCoin, which they claim Austin was the first. Whoever was the first, I'm not quite sure. But either way, there's one in Austin. RoboCoin,
Austin, New Mexico.
Mm-hmm.
New Mexico.
Taiwan said no. They tried in Taiwan. But I mean, you feel that.
And then you got Canada that did it in 1 month, $1 million worth of transactions through one single ATM. So
that was in Vancouver, I believe.
Vancouver, absolutely.
How does that? I've actually met a few guys who have made some money in ATM, in the ATM business. How does it even work? I mean, was it similar to the payment card ISO industry where banks sort of let everyone loose and said, "Hey, go distribute these, take a cut on the sale"?
I'm raising my hand. I'm one of those guys. Back in the
so Brian, how many
late
ATMs
1980s?
do you have out?
At this point, zero. It's zero. But at the same time, I had a lot of payphones out there too. I mean, we were doing a lot of things. Since we were out in the field, the idea was to try to maximize our benefit to the merchant. And there were certain environments where ATMs made a lot of sense. Now, the ATM laws were constantly changing through the 80s, 90s, and early 2000s. The banks really wanted nothing to do with placing an ATM machine anywhere where there wasn't the potential of $50,000 moving through that machine at some prescribed event. Let's call it 30 days. A lot of times that was 10 days or 7 days. There's also that really prickly little problem, and that is who's going to ensure that the money gets into the ATM machine and who's going to protect it. Now, the reason why independent companies flourished in this sector is that we were able to identify huge opportunities where ATM machines made sense. In fact, you would walk down, different, strolling streets like Austin and in Austin and stuff, and all of a sudden you'd see this independent ATM machine in front of, a convenience store or even a shoe store, and the opportunities were great. The laws allowed you to collect what were called foreign ATM transaction charges, foreign ATM cards. Of course, if it's not a bank, every card coming into that is a foreign ATM card. So at some point, you could collect, $5, $6, in some cases $10. There was even the opportunity of collecting a percentage. Those were rare, but
$10.
I never did those.
Are you talking about a transaction fee for
yes.
using Oh my God, it's highway robbery.
Well, let me tell you,
And it still exists today, by the way.
I didn't place these ATM machines in some of these locations, but let me give you one use case. One use case where I know $10 ATM existed in the United States, and maybe to this day, but I don't visit these places, and that is clubs where people take their clothes off, otherwise known as strip clubs. Strip clubs were an incredible opportunity, and these ATM machines would have a $10 hit for people to use their charges, and so that's obviously. But we were able to get into train stations, into bus stops, into where taxi cabs coalesce. And
so how are these guys, do you think, going to make money? How is Robo making money?
Well, I mean, to me, the Bitcoin ATM at the moment is a glorified vending machine. I may be wrong, but that's what it seems like right now.
That's all ATMs are really anyway.
Yeah, so you're putting money in, getting Bitcoins out. It's just making the purchase of Bitcoins absolutely frictionless, Just put your money in and get the Bitcoins out.
And it's a bit of grand theater, right? Because at least for the first infant phase of these ATMs, and I visited the one in Canada, and I visited other examples of this. It's grand theater because people want to go up there and make sort of some kind of statement. And it doesn't matter if Bitcoin's going down or going up. People just want to kind of interact with it. And it's
I think they're cracking a problem, which is right now, if you need to buy Bitcoins, you have to go through this process. You have to register somewhere, and et cetera, et cetera. But the ATM offers one thing that many, many people sort of skip. It's you inserting a financial instrument, your credit card, your debit card, in which case you have already been KYC'd. So you are not an anonymous entity. You are a very identified entity, entering your card and getting Bitcoins out. And that you've short-circuited that entire registration problem down to zero.
Exactly. And the idea that the reason why most people would want to use Bitcoin is to become somewhat anonymous, I think that's just unfortunately a sort of
pseudo-anonymous.
Yeah, exactly. But reality, why are people doing this? Well, let's look at Mt. Gox, all right? Mt. Gox, everybody is looking at it today and saying, wow, look at it. It didn't really have that big of an impact on Bitcoin. You can't get money in or out of Mt. Gox. And if you were in the United States and you tried to KYC to Mt. Gox, you're sending your driver's license, your mortgage paper. I mean, they wanted all sorts of identity to a company in Japan, and you don't know what's going on with that.
Actually, you can't because the U.S. is on the blacklist. You can't get for all exchanges.
I'm not sure if I understand.
On Bitstamp, BTE, and Mt. Gox, they do not take U.S. clients.
Maybe not officially, but they have U.S. clients, let me tell you. And
no, I'm sure. But I mean, when Douala funds thing happened, that's when they really stopped. I mean, they would not accept a U.S. ID or a U.S. bank account or a U.S. credit card or a U.S. debit card, what have you.
Well, unfortunately, for U.S. citizens and citizens around the world, Mt. Gox essentially has their money. And if you had a Bitcoin ATM down the street, you wouldn't have this problem because your money would be there in a paper wallet, or if Coinbase was moving very quickly, it'd be in a Coinbase wallet. And see, there's those opportunities. I mean, if you wanted to buy Bitcoin today and you wanted to do it in a very controlled setting, the easiest way to do it would either be an ATM machine like this or Coinbase. And Coinbase is very simple.
Well, there's one difference here. So Coinbase is not an exchange. I mean, we have to.
But you're buying Bitcoin from the consumer perspective. You're still buying Bitcoin.
You're buying, but you're not trading. You can't trade on Coinbase. Insofar as I know, there isn't a Bitcoin exchange in the U.S. at present.
That's very true.
CoinX, maybe Megan Burton, who's the CEO, she might come up with the first one. But as an exchange, as a trading exchange, there isn't one because there is no place where you can take your Bitcoins, go trade it, and sort of up and down, or put your values in, and so forth.
And that's why California wants to recognize this as a legal currency, because that would allow the very first U.S.-based exchanges to take place in an environment that regulators feel at least a little better about than what it,
And that's what the Wink twins are doing, the Facebook twins. Because
I think California is realizing they can open up new forms of tax revenue streams. They've had such success with the opening up marijuana that they want to get into more slightly edgy industries. I'm looking.
And technologists are behind it. I mean, there's some very large venture capitalists that are behind getting this recognized as a legal currency, and so it's not an accident. This thing is flying through with everybody saying yes, from bankers to everybody in Silicon Valley.
I mean, anyone who's holding on to bitcoins, who has access to exchanges where they can buy bitcoins, where liquidity is present, then the Bitcoin ATM makes a lot of sense, because it simply short circuits the entire process. I mean, you could have never bought bitcoins before. Just put your debit card in, give the money, get bitcoins out.
God, isn't that good? So I'm looking at a report where it says there's 376,000 ATMs currently deployed in the United States that transact. It's
now over 500,000. You're looking at a report that's probably about 2008 or something.
That's true. Mm-hmm. That's true.
So with that many of them out there, are we really going to? I mean, is there a better way? Right? Are we really going to redeploy new machines, or is there going to be a company that comes around and retrofits existing machines to accept Bitcoin?
Any ATM can do it. Any ATM can instantly
your
be
NDS,
converted.
your NDS software on most of these ATMs can do anything. The only thing is, again, rolling out even a screen on an ATM is such a elongated process for most banks, because what happens when you have to share the screen across other ATM networks or other banks? How does your screen show up on other banks? So it's a very long drawn process, one that's filled with compliance and regulations and so forth. But can it be done? Absolutely. Do you want to do it? Well, again, it's the inertia. The banks see this as a huge inertia. They have to invest so much into technology and processes and pilot rollouts. It's perhaps cheaper for entrepreneurs to invest in an ATM machine, make one that's product specific to cryptocurrencies, and insert it into the network. You have to understand there's no cash being dispensed from these machines. There's no cash whatsoever. You're doing nothing but swiping a card, getting the authorization, taking the funds in, going to real time to the market maker, seeing if those coins are available, buying them, and spitting out a receipt that says, well, here are your bitcoins. That's it.
Now, Faisal, could a Bitcoin ATM be legal in your part of the world right now? Could an entrepreneur do this with a money transmitter license or whatever the equivalent is?
So, and I read the license for 3 countries, which is Pakistan, India, and the GCC, specifically UAE. And in all those 3 countries, this is gray meaning it's not even defined. There are particular areas. So Bitcoin may not be defined, but here's the catch. If you were to put in a payment facilitating machine or automated teller machine into a network without the appropriate licenses, you need a license for that. In this part of the world, like you were saying, you cannot just go and get an ATM, buy an ATM, and say, well, I live in a flat, apartments where there are 1,000 people, 1,000 apartments, and I think they need an ATM. No, you can't do that. Only the bank can do that. So self-owned ATM or owner premise-operated ATMs are not yet part and parcel of the culture over here. Again, a huge opportunity.
Interesting. So you can actually use that gray area with the proper startup to possibly influence this type of change? Or would that be how to do it? Would somebody just go out there and do it and then see what happens? Or would they sit with bank regulators and try to cobble something out? How would innovation take place in that part of the world?
So great question. And banks are open to it. It's just this whole concept, even to people who are very well versed, people like yourselves and myself, it is a very complex ecosystem to understand. I mean, we're learning as we go along. I mean, I did not know about transaction malleability about, say, 3 weeks back. I had no idea about it. So, when you go to a regulator, they need to look at every single thing, and they only have so much time. So it's all about education and awareness. And I think once they're educated and made more aware of it, that, this is not a threat to the existing fiat currencies. This is a benefit, an add-on to the society, et cetera, et cetera. I think they'll open up, but they're being very, very cautious about it. And it depends what mood they're in. I mean, if they're having a bad, Monday, you really don't want to be telling them, because they'll just say, nope, thank you, nope. A
lot of banks have bad Mondays. Let me tell you from experience, I've learned that.
So do you think there's going to be a similar move as you see Balanced and Stripe start to accept Bitcoins? Is there going to be a similar move in the brick and mortar payment processors where I could swipe my coin card and pay in Bitcoin? Because essentially I sort of question obviously cash is valuable now and ATMs are valuable. And I think there's also a hidden agenda with the Bitcoin ATM, and that it's an education tool, right? Only 1% of
who issues you the coin card? Number one. Number two, what's the transaction confirmation time?
Well, the coin card would obviously, let's just do another thought experiment, and I'll do a fantasy and I'll give a business strategy right now. Mm-hmm. All right. The coin card would be issued by Coinbase. Coinbase would, again, I'm not saying they're doing this. I'm just fantasizing now. Coinbase would say, you want to monetize your capability in this card to pay at the greater world. Now, all of a sudden, all of these APIs, like what Balance did with Coinbase. And, I'm not saying it's a Coinbase world. They just happen to be the ones that are the most innovative at this point. I think they're moving the fastest. There's no doubt about it. I think, first off, I don't see any difference between a mobile transaction, a retail transaction, or an online transaction in a real sense, other than the fact that the interchange rates are different because the fraud levels are different. But from a practical standpoint, from an API level, they're indistinguishable. Now, you have to look at and that's becoming so gray. It's just like we were talking about person-to-person payments versus business, consumer-to-business payments. There's no difference, really, when it comes down to it. It's just a matter of a perspective and the shades of gray. So now we have this card that's, say, it has a mag strip on it. And merchants who are using existing infrastructure read that. Maybe a company like Discover, maybe a company like American Express says, yeah, we'll have that run through our network, and we'll charge the merchant, a few pennies a transaction, but yeah, we're fine with that. There's a number of reasons that they may do that. There's a number of reasons they may not.
Yeah, but Brian, the person buying their double decaf cinnamon latte at Starbucks is going to charge his Coinbase card, has to wait 10 minutes before the confirmation comes in.
Yes and no. If in fact it's inside, say, the Coinbase ecosystem, and if in fact they're using the more advanced ways to allow these transactions to move forth in the mining operations. Right now, the mining operations are such, I'm getting transaction fees on Bitcoin transactions that are starting to get close to the amount that I'm making on discovering Bitcoin in these larger mining pools with lower hash rates. On my high hash rates, we're getting so many Bitcoin still that the transaction fees are relatively non-existent. Why do the transaction fees inside of a Bitcoin transaction matter? Because they move to the front of the line. And in the confirmations, some confirmations only...
There you have it.
Yes.
I think that's the secret.
A lot of people don't know this is going on, and it's going on in a very methodical way. But a lot of companies like Coinbase, and I don't want to speak for them, but what they can be doing is they say, I only need 3 or 4 confirmations. Now, if they're running their own mining operations, they can do 3 or 4 confirmations very, very quickly. And the rest of the world starts confirming and building the blockchain. And it's really about time. All mining is, from that regard, is we're building a time code on exactly when this took place. That's why the malleability issue, we all knew that, us miners and people who studied the original papers, we all knew that the 51% problem and the malleability problem always existed, and there are remediations that you could do. The problem with Mt. Gox is they didn't really do it. They built a super wallet, which is essentially the same wallet that you could download on your computer, but they were managing in a way that unfortunately allowed this malleability problem to be magnified, and they should have done things to not let that happen.
You think that's going to be the solution then? Essentially, specific industries, say the coffee shop industry, is going to have a bid to ask price on the speed at which they...
No. This is all going to take place in the background. The merchant and the consumer will never know it. The mining operations will definitely know it, because everybody says, well, what happens when the 21 millionth Bitcoin is discovered? Well, somebody's got to perform those transactions, and they're going to be transaction fees. They're not a lot of, it's not a lot of dollars. It's just like any other micro, transaction.
Well, I mean, you're
transaction.
also assuming that Bitcoin is the only protocol or the only money.
Exactly.
But if you were to use Ripple, XRP, it's instantaneous. It's almost, I mean, it's less than, 30 milliseconds and it's transaction confirmed.
Exactly. And therein lies opportunity. See, whenever we see a problem as technologists, that's when we turn on our opportunity brain and say, okay, well, how do we fix that? So, within all this, you have the Ripple scenario, which is beautiful, but you have other things like, having I call early consensus transactions. So we can see this moving there. Now, the question is, why would the consumer use Bitcoin to buy coffee? That's a whole nother conversation. And it's going to probably be an ongoing dialogue we're going to have for a very long time, because I'm not convinced that you want to use Bitcoin to necessarily buy coffee today. But there's going to be reasons.
I think the business case right now for ATMs, Bitcoin ATMs, is the vending operation per se. Being able to buy in a frictionless manner Bitcoins. I mean, just put my card in, get my Bitcoins out. For anyone who wants to do so, and the more the merrier. And I think the transaction part, what I do once I have those Bitcoins, is something that companies are, and I'm sure quite a few startups are working on that part.
Exactly.
Right now,
let me ask you guys
let me ask you guys a final question. We'll place a little wager on it. In 1 year from now, so today is February 22nd, 2014. 1 year, 365 days. How many ATMs in the United States will accept Bitcoin in 1 year? Give me a number.
You mean generate Bitcoin as a product?
Accept Bitcoin. Accept Bitcoin in exchange for cash. So they'll give you US dollars and they will accept Bitcoins.
Oh, okay. So you're doing it reverse. So what I'm thinking is, I put money in, I get Bitcoin out. You're saying I put Bitcoin in and cash comes out.
Yeah, I can't imagine.
There's two different things.
No. If you're talking about the former, then my answer is about 1,000. If you're asking about the latter, I would probably say 0.
I would say 0 too. Yeah, because if it is, now let me hedge that just a bit. If it is, it's going to be in California, unless South Dakota does it. Listen, one of these states, just like what South Dakota did with banking, the reason why, if you really look at where most credit cards in the United States, the bank location is originating from, it's a South Dakota location. What they did was they took this state, which was not known for much other than maybe some farming and some manufacturing industries, and they said, we need to get finance in here. So they adjusted the laws for financial institutions to make it valuable to locate there. We're going to see that happen today. We're going to literally in the next couple of weeks, we're going to start seeing that fight. And I can tell you, California is trying to be in front of it, but a lot of these other states, they're not going to sit on their hands. They're going to move on this, and in a lot of ways, it's going to be far ahead of where the federal government is going to be.
I also want to add that cashing out is a problem that is probably looking at BSA laws and cash over counter and identification. Yes. So what if I am not with Coinbase? I mean, is this ecosystem only going to be limited to Coinbase cards or CoinX cards or what have you? What if I just have Bitcoins and I want to enter my Bitcoin number, whatever it is, and cash out? The ATM does not know who I am. The regulators do not know who I am. And I don't think so that's going to happen anytime soon.
Yeah. And this is the opportunity for so many startups. I mean, there's going to be, Coinbase is really very far ahead, but I've been talking to a lot of startups.
But even then, they choose one.
What's that?
They chose one approach. I mean, there's so many different approaches. There's so many.
Exactly.
Yeah, I'll tell you of an approach right now where you could go to a site, any site, use any of your Visa or MasterCard, attach your Bitcoins to it, and be able to cash out. Because once you give your Visa and MasterCard, that basically says that the banking system knows who you are. So you put your Visa, MasterCard to say, well, what do you want to do? You want to do cash, from your credit card? No. Oh, guess what? You have Bitcoins. You want to get your Bitcoins out? Yeah, sure. I want to take my cash out. And the only reason is because it's by association. You've sort of tagged your Bitcoins to your known identification, financial identification instrument, which is your Visa or MasterCard. And that's the only way you could do it. Obviously, there are other ways, but this would be the simpler way.
So we come full circle.
I love that.
We come full circle. We're talking about banking and how banking is going to look. I think the modern banking system, and it's always going to be a moving target, is going to take into account all of the financial aspects of your life. And we've only covered a very small sliver of the milestones, mortgages, car buying, and now holding Bitcoin within all of your financial profile. We also could talk about investment and crowdsource funding. Imagine if we could amalgamate all of these things, like your donations to possibly people in the world that need money, your Kickstarter programs, all of this amalgamated into one financial dashboard. Imagine what the world would be like if we could do that. And I don't have to figure how much doggy coin I have, Litecoin or Aurora coin or whatever. It's all in one banking system. That's where it's going. That's the future.
That's it.
And
not even one banking system, multiple banking systems, but single dashboard. Single dashboard.
That's where the opportunity is. And that's why what Simple was about and continues to be, and the next Simples, the excitement is that's where we're going to be going. 5 years from now, we would see all of this as being so obvious. Right now, it's sort of like,
it's all really
wow.
simple.
Yeah.
It's all very simple.
All right, guys. I think we should wrap this one up.
Beautiful.
Thank you.
All right. Great show.
Thank you.
Talk next week.
Take care, guys.
Bye-bye.
Bye-bye.